Hey everyone, welcome back to Corporate Decoder, the place where we spill the tea on Wall Street, secrets, and today we read digging into some fresh debt offerings that might make you say, wait, what is going on here? We're about to decode a financial report that is all about Franklin BSP Capital Corporation and their recent move to raise a cool $300 million by selling notes. Stick around because understanding these deals is key to understanding how companies really make their money and, more importantly, how they plan to use it. First off, let us get into the nitty-gritty of this filing. It is a Form 8K, which basically means it is reporting a big event that the public needs to know about immediately. And for Franklin BSP Capital Corporation, that big event is a notes offering. So picture this: on the 2nd of October 2025, Franklin BSP Capital Corporation, or the company as they call themselves here, teamed up with US bank trust company National Association, who is acting as the trustee. They entered into what is called a fourth supplemental indenture. Now, that sounds super technical, but really it is just an update to an older agreement, the base indenture, and further modified by a second supplemental indenture. Think of it like adding a new chapter to a contract, but this new chapter is about borrowing a substantial amount of money. This new chapter is all about the company issuing $300 million worth of notes. These aren't just any notes. They were specifically referred to as 6.000% notes. Due 2030. This means they reborrowing this money and promising to pay back the lenders 6% interest per year, and they plan to pay it all back by the 2nd of October 2030. So, to break down the maturity date, these notes are pretty long. Term, they redue in October 2030. Now, the company has the option to buy back these notes, either all of them or just some of them. At any time, they'll decide what price to offer when they do this, and those prices are detailed in the agreement. Let's talk about the interest payments. These notes are going to pay interest at that 6% rate every single year, but here is a detail that is pretty standard for bonds like these. They'll pay it out twice a year, not all at once. The payments will happen on the 2nd of April and the 2nd of October of each year. The first interest payment will be made come the 2nd of April 2026. Now, this next part is super important for anyone holding these notes. The agreement has a clause for what happens if there is a change of control repurchase event. Basically, if something big happens, like the company gets bought out or merged in a way that significantly changes its control, they'll usually have to offer to buy back all the notes that are still out there. And they'll have to buy them back at the full asking price, plus any interest that is already built up but hasn't been paid yet. This is a way to protect the investors if the ownership of the company changes hands. So, who are they selling these notes to? The filing says they were offered to people who are considered qualified institutional buyers. That means big investment firms and other financial institutions, not necessarily individual investors. They also offered them to certain non-US persons outside of the United States. This is a common way for companies to raise large sums of money without going through all the regulatory hurdles of a public offering to everyone. They're pretty much saying only big players can get in on this deal. And a crucial point here is that these notes haven't been registered with the Securities and Exchange Commission. This means they can't be easily bought or sold in the US, unless they meet specific exemptions. So this offering was done under specific rules that allow for private placements like this. After all the fees and expenses, Franklin BSP Capital Corporation ended up with about $294 million from this $300 million offering. That difference, about $6 million, is essentially the cost of borrowing this money. It might seem like a lot, but for a deal this size, it is pretty standard. So what are they going to do with all that cash? The company plans to use the money to pay off existing debt, invest in their portfolio companies, meaning lending money to other businesses to help them grow, and for general corporate needs. This is classic corporate finance stuff, raising money to manage your existing obligations and fuel future growth. Now, there is another piece of the puzzle here, a registration rights agreement. This agreement was made on the same day as the notes offering. It is essentially a promise from Franklin BSP Capital Corporation to the initial buyers of these notes. What this agreement means is that the company has to eventually file something with the SEC. Specifically, they need to file paperwork that will allow an exchange offer. This means they'll offer to swap these original notes for new notes that are registered under the Securities Act. They have to try hard to make sure this registration gets approved. If they can't manage to do that exchange offer, they'll have to file a different kind of registration statement that allows for the resale of the original notes. And here is the kicker for the company: if they don't meet these registration deadlines, they'll have to pay extra interest to the note holders. This is basically a penalty to ensure they follow through on their promises to make these notes more easily tradable down the line. It is a way to keep the investors happy and the company on its toes. Interestingly, this filing also touches on the idea of creating a new financial obligation. And that is exactly what this notes offering is. It is Franklin BSP Capital Corporation taking on a direct financial responsibility to pay back the money they've borrowed, along with all that interest. Now, looking at the exhibits, we see a few key documents. The first is the original indenture from March 2021. Then we have the fourth supplemental indenture from October 2025, the one we've been talking about. There is also the form of the actual 6.000% notes, so you can see exactly what a note looks like. And importantly, the registration rights agreement we just discussed. These are the documents that lay out all the detailed terms and conditions of this debt issuance. Now, let's pull back and take a look at the bigger picture here. Franklin BSP Capital Corporation is raising a significant amount of debt. This isn't necessarily a bad thing in itself. Companies often use debt to finance their operations and growth. However, the nature of this debt, the unsecured status, and the covenants related to asset coverage and financial reporting are important. The fact that they're reissuing unsecured notes means that if the company were to run into serious trouble and even go bankrupt, the holders of these notes would be lower down in the pecking order for getting their money back compared to secured lenders, whose loans are backed by specific company assets. Their senior unsecured notes will rank equally with other unsecured debt, but below any secured debt, they also rank structurally junior to debt within their subsidiaries, which is a common characteristic of holding companies. The covenants requiring compliance with asset coverage rules, even if they re not strictly a regulated investment company, suggest they want to maintain a certain financial stability and investor confidence. The obligation to provide financial information if they re no longer subject to SEC reporting is a good safeguard for investors. The change of control repurchase event clause is a critical risk mitigator for investors. It basically says that if the company's ownership structure changes significantly, the investors get a chance to exit their investment at par value. The fact that they offered these notes through Rule 144A and Regulation S means they're retargeting sophisticated investors who understand the risks. This private placement approach is efficient for large capital raisers, but limits the broader public's access. Overall, Franklin BSP Capital Corporation is actively managing its capital structure, likely to fund its investment activities and manage its existing obligations. The success of this debt issuance, indicated by the full faith and credit of the company backing it, and the commitment to register the notes eventually, suggests a degree of confidence from their investors. However, the inherent risks of unsecured debt, especially in a fluctuating market, remain. Their strategy of using borrowed funds for investments and general corporate purposes is standard, but the effectiveness will depend on the quality of their investment decisions and the economic environment. The company's current direction seems focused on expanding its portfolio, and this debt will facilitate that. The main risks are market volatility impacting their investments and their ability to service this debt. A key opportunity lies in successful execution of their investment strategy, which could generate returns exceeding the cost of this debt. Alright, that is our breakdown of Franklin BSP Capital Corporation's latest filing. What is your take on these numbers and what they signal for the company? Future, do you think this debt offering is a smart move? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives into corporate finance. Don't forget to check out the Discord link in the description below to join our community of finance enthusiasts. Thanks for watching. See you next time.